we are going to say tonight. Tonight we're going to finish chapter 3 ethics handout. And then we do the chapter 3 multiple choice extra credit. And finish monetary unit sampling. And tonight I will also class it'll be due on 14th. So I'll send out the chapter 3 exam after class and due on Friday the 14th. So a week from this Friday. Okay, so let's go ahead and get into back into the chapter 3 handout. And I think we were on, I don't know if the page numbers are right on mine, but on the confidential information, just above problem 19. I think it was subpoenas we stopped at. Okay, subpoenas. CPAs must comply with valid subpoenas. Subpoena is a court order. So this is a court order. That they must comply with. Now, that's the only thing they have to comply with, though. A lot of times when you'll have lawsuits or something like that, you'll get a lawyer letter or a letter for to get background information, all that. That's not good enough. They have to be able to go to a court and have a court issue a subpoena, and then you are required to give the information only the information contained in the subpoena. So if your client, for whatever reason, they get sued or they get authorities come out, whatever happens, IRS, something like that. If you get served with a valid subpoena, you must comply with that. If it's not a subpoena, if it's anything less than a court order, you do not have to, and you should not comply with it. So if you get a lawyer letter, looking for background information or something like that, ignore it. So it's only for valid subpoenas that they are, they do have you have a confidential information, it is confidential, but it's not to the same extent that say a lawyer has with their client. It's up to a point. There are a few states where it is a little bit more strong, the confidential information. But generally speaking, you must, if they give a valid subpoena, a court order, you have to comply with it. Okay. Number 19. Utter evidence that their public trade client is routinely violating EPA laws. Okay, now generally EPA laws are not directly related to the financial statements, but if they could become to the point though that they may have a large liability built up, that, you know, that there could be a problem because of the contingent liability that's amassing because of these things. In that case, it might, you know, end up being so problematic that you go to the board of directors. Okay, so they contact upper management and the board of directors. I'll do it, or it's probably say did not respond. Did not respond within 24 hours. Okay, well, this is publicly traded. So in this scenario, what should they do?
So even though the company is for the, we know that the Environmental Protection Agency is not the financials, but will they still be required to report them to, or I'm asking a question, but I should be given an answer. I would say, is it C?
Yes.
Turn over the case to the SEC.
Yeah, if it is enough that, you know, even if it's not directly related, if it's enough to mean that it's a material problem, and that there's a possible material liability hanging out there, for instance, yeah, you can give it to management and they don't say anything about it. And you know, you probably let them know at the same time that if they don't respond in 24 hours, you have to contact the SEC. But yeah, if it's to the extent that it's material, you know, that there could be a huge amount of liability hanging out there for cleanup, fines, all that kind of stuff, that you certainly can do it. And you're required to, basically, if it's material, you're required to report it to the SEC if they don't respond appropriately. Okay, I'm going to move this down to the next page. The others uncover evidence. The CEO of a publicly traded company routinely parks his car illegally in a handicapped parking spaces. When presented with the evidence, the client's upper management board did not respond in 24 hours. Under this scenario, what should they do?
Nothing.
Yep. Yeah, this is obviously not going to be material. Now, it's a really jerk thing to do, but at the same time, it's probably not material, and you do not have to contact the SEC about that. So they're basically looking for things that are serious, the things that are material to the financial statements. And when those things are not dealt with appropriately, then you go to the SEC. Okay, contingent fees. I'm going to put something underneath contingent. I'm going to put it before contingent fees. Let's say normal fees. I shouldn't say normal fees. I say flat fees. Flat fees are always allowed. For example, charge a client $100 to do their taxes. So it's $100. It's a flat fee. Those are always allowed. Contingent fees are different in that the fee is contingent upon something happening. So when we say contingent fees, that means something must happen before the fee kicks in. For instance, I'm going to take an umbrella if it's raining. Okay, so me taking the umbrella is contingent on it raining. If it's not raining, I'm not taking the umbrella. So a contingent fee is kind of like that the fee isn't paid unless something happens. Okay, so contingent fee. So there are some, for the most part, those are allowed. But there are a few cases where they are not. So contingent fees are mostly allowed. So mostly allowed except in 3 circumstances. Okay. They're not allowed for audit fee. I gotta do something here. Hold on. Audit fees. Also known as a test functions. You're attaching to something. Example. Extra $10,000. Oops, 1 0. Okay, so this is not allowed. You know, how much is the audit? It's $80,000. I'll tell you what, if you give us a clean audit, I'll give you an extra 10,000. We'll make it 90,000. If you give us a clean audit, you cannot take that. You can always charge the 80,000. That's not a problem, but you cannot have this contingent fee here that, you know, for a clean audit. So these are not allowed. I should probably put not allowed here somewhere. Audit fees. Tax returns. Example. Your audit fee will be 20% of your tax refund. So notice that your fee depends on the refund. So this is the contingent. So this is not allowed. Now, if you're not a CPA, people do that all the time. But if you're a CPA, you cannot do it for a contingent fee. Are there tax places that say, yeah, we'll just take 20% of your refund? Yeah, there are. However, if you're a CPA, that's a no-no. And it is a no-no for, that's a technical term by a no-no. For a couple of reasons. Well, first of all, you're a professional and you also owe a duty to the public. And so having a contingent fee for a refund might make inappropriate tax returns being filed, which hurts society as a whole. And one of the things you have to remember, if for CPAs, we're held to a higher standard. So there are things that other people can do that we can't, and this is one of them. Now, they've also closed up the rules because some unscrupulous CPAs were hiring people that were not CPAs and then having them do this kind of work. Anyone who is paid or supervised by a CPA can also not do it. So, because they used to hire people that weren't CPAs and then do the contingent fee stuff. So, anyway, this is a no-no. So not allowed, you can't do it for tax, audit fees, can't do it for tax returns. And something we haven't talked about, there's no easy way to do it, compilations. First question should be, what is a compilation? A compilation is kind of a funny term, but here's what a compilation is. Compilation is simply making financial statements for your client. So you're just taking their information and making financial statements out of it. So compilation is simply making financial statements for your client. I shouldn't say use for you on that. I'll clean this up in a second. So that's what a compilation is. They give no assurance, by the way. So it's not an audit. You simply take their information, whatever they give you, and you make financial statements out of it. And truly, a compilation, it could be somebody in a, let's say someone who does photography, and they just want to know how the business is doing. And they're not really into finance stuff, so they call you and you make their financial statements for them. You just take their information and make the financial statements. You're not doing an audit. You're not, going through and doing testing and all that kind of stuff. It's just simply taking their information and making financial statements. Now, sometimes they might use those to get loans. And if they do, for any kind of loans or investments or something, trying to get investors, you can't take that on a contingent fee. And what I mean by that is, okay, how much does it cost to get the compilation in? Okay, $300. Okay, I'll tell you what, if I get the loan, I'll give you an extra 1,000. Okay. That creates a obvious problem, because again, you're not auditing those. However, you are creating those financial statements, and it might influence somebody or have the appearance that they are not on the up and up, or both fact and appearance. So if it's a compilation, somebody making the financial statements, if it's let me go back to the page here. So if you're simply making the financial statements, the actual contingent cannot be on getting a loan or getting financing. Whatever it is. So this would be the contingency, you get an extra loan or financing for an extra $1,000. A lot of your smaller CPA firms will do a lot of compilations. So if you're starting up your own CPA firm, it's not uncommon to do compilations at all. There's no problem with it as long as you don't take a contingency fee if they get financing or a loan on it. But compilations are very common. Another thing about compilations is because there's no assurance given, you don't have to worry about independence. So if your spouse is running a photography place, there's no problem with you making the financial statements at all. There, you had one line on the end of the compilation report that says, I am not independent. However, there's no problem with it because you're not giving any assurance on it. You're simply taking the information and putting it into financial statements. So the compilation is kind of a weird report. Okay. Actually, discreditable. There are a few things that could be actually discreditable. Not cooperating with subsequent auditors. So generally speaking, if they change auditors and they fire you as an auditor or whatever, you quit or whatever, you should cooperate with subsequent auditors. That doesn't mean you do it for free, but you should help them in the normal things that you would normally do for helping the subsequent auditors. Okay. Disclosing CPA exam question. Not filing your taxes. Those are all things that are X discreditable, and you can some of those things you can lose your licenses. You can lose a license board depending on the state. They almost always have those in the laws. But when they say the discreditable, they're actually talking about the AICPA. Everything on the CPA exam comes from the view of the AICPA. So yeah, you can lose your license. It really depends on the state what their laws are. But generally speaking, those are the kind of rules that they have. Especially these two are almost always state laws. Okay, referral fees. Are not allowed if the auditor. So referral fees are not allowed if you are the auditor. So if you're auditing someone's books, you cannot take a referral fee. And they may ask you, who should I get this liability insurance from? You can't take it. If you are not the auditor, so let's say you're not doing the audit, maybe just do a compilation for them or something like that. If you're not an auditor, you can't take referral fees, but they must be disclosed to the client. So you have to tell the client about the fees. So if you're the auditor, it's a no-no. If you're not the auditor, let's say you're a CPA firm, but you don't do the audit for them, or maybe they don't have an audit, they don't get an audit taken, but you take care of their financial statements and stuff. You can, as long as you disclose that to them. So basically what you say is, yeah, do you know a place where I get life insurance? You go, oh yeah, this is the place that I use for life insurance. I got to tell you though, I get $25 for sending any clients there. As long as you're upfront and tell them about it, it's fine. So if you're not the CPA doing the audit, it's allowed. CPA is a tax advisor. I'm gonna skip this because there's a whole table down here on that. Oh, no, I can't skip that. I realized what that was about. I'm sorry. Oopsie daisy, as a tax advisor. I was thinking like it was something. Okay, CPA as a tax advisor. A CPA must check a client's tax return for reasonableness. And again, this is part of that responsibility to the public. So you cannot be associated with a tax return that is, they obviously fraudulent. You cannot be associated with that. So the client brings you in for all this information and it doesn't look reasonable at all. You know, they have tons of deductions or something crazy, you know, something going on there. You must check it for reasonableness and question them if there are things that are not reasonable. And if it is such a the extent that you're not satisfied that those are reasonable, then you can't do their tax return. And that's because you not only do you have a fiduciary duty to your client, but you also have a duty to the public, being in the professional class, like doctors and lawyers and all that kind of stuff. Okay. So, non-attest for services for audit clients. Now, be careful here. This is only for audit clients. If there's different rules, if you're not doing their audit, there's different rules for you. But this is if you are auditing their financial statements. If the CPA firm is not auditing the client, then these rules do not apply. So this is only for the CPA firm that has the audit, performing the audit for the client. And this is kind of some of the differences between. I'm going to add a little line here. Add up here. So this is for issuers. And this is for non-issuers. Okay. PCAOB, most of these are going to be no. Bookkeeping. You guessed it, no. AICPA, yes. You can actually do the bookkeeping for your client. And I know that sounds funny, but it is just doing the bookkeeping. It is not actually approving journal entries or anything like that. The one thing you got to realize too is that these AICPA rules, they apply to everyone, even very small businesses. So a small business, it might be reasonable for them to have you do their books for them. You'll do the bookkeeping. They'll make the journal entries. You don't have the management approval of putting in journal entries, but you can do the bookkeeping for them, and then they'll make the approval and enter those things in, and then you can do the audit still. Not so for publicly traded. You realize publicly traded companies are gonna have, a separate accounting department and all that kind of stuff. So if you're wondering why some of these rules are kind of lenient, it has to do with the client size, not necessarily anything else. Financial system installation, no. Non-issuers, yes. It's yes, as long as they didn't make the accounting system themselves, which most small CPA firms won't do anyways. But anyway, accounting information system. So it used to be that auditors would install the accounting system, then they go in and do an audit on, you guessed it, the accounting system. Appraisals for valuations, no. Appraisals for valuations, generally speaking, this is a kind of a tricky one. It's yes, but only if there is a clear market that which is a criteria. For instance, what's the value of the stock at year end? Well, you can just look it up on the, what was the ending your stock in the New York Stock Exchange or whatever. So if there's clear criteria, they can do it. There cannot be any decision making. There can't be any judgment or uncertainty in it. Internal audit functions for the client, no. Yes. This is always a weird one too. They used to do the internal auditing, some of the CPA firms for their, which had to be way more expensive than the just hiring their own, but management or human resource recommendations, no. Oops. Yes, but they cannot make the decision. You make recommendations, but no decisions. Investment service recommendations, no. And this one is pretty generally no also. They can do a little bit of simply asset allocation without any specific investments being advised. What I mean by that is they may say, well, how much should I have allocated in the stock market? How much should I have allocated in the bond market, international market, that sort of thing. You can give them those general guidelines, like, 20% in the stock, whatever it is. You cannot tell them, okay, buy this stock, and this stock. But general allocations you can, but generally the overall, like, which companies to invest in, can't do it. Legal services, not related to auditing, no. For non-publicly traded, yes, by default. There actually are no rules on this. The ACCPA, one of the weird things is they don't have any rules on legal services. So by default, it's yes. Tax planning for common issues, yes. This is the weird one of the yeses. And yes here too. So if they're common issues, you can do it. Tax planning for unusual or aggressive issues, no and no. Oops. And this is because The auditor cannot be an advocate for the client. Oops. And if you have this aggressive tax issue, you'd have to be standing before the court saying, yes, do this, do that, whatever. You'd be an advocate for the client. And you can't do that. You're supposed to be one of the, you're supposed to be one of the people that reviews their stuff, that checks up on them. You're not an advocate. And this all goes through even beyond tax things. Your client might say, can you come into the bank with me and tell them, I know we got these financial statements and these audited financial statements. Can you come to the bank with me and tell them, that we're a good company and that we pay our bills on time and all that? Can you come in with it? You can't do it. At that point, you become an advocate for the client, and that is not your role. Your role is to be objective. You cannot be a rooter for your client. So it goes beyond just the tax part. You cannot be an advocate for your client. Individual tax for services for officers. No, this used to be very common practice. If you took whoever got the audit would do the taxes for free for the all the upper management and directors and all that. That is not allowed anymore. There was a funny, I don't say funny, but an odd one that happened with that. And the onus is basically on the board of directors, is on the company. But anyway, at this one company, two of the officers had their CPA firm do their taxes for them. And the company, instead of firing the auditors, fired the two executives. Because for whatever reason. But I mean, it's a real serious thing, and you can't. It's a no-no. You can't do the taxes for, executives. If they're not an executive, you can do the taxes for them. So, okay. Oh, that's it. Okay. So, any questions on any of that? This is a real. This whole chapter is really kind of nitpicky, and that's just the way it is. And again, it's a big part of the CPA exam because it's all about independence, and the only thing that we give is credibility to the financial statements. That's all we offer. So independence is really big, and they really test it, quite heavily, on there. So what I'm going to do is I'm going to send out the the multiple choice questions for chapter 3. Let me send those. And I think then we'll maybe take a break and come back, but I'll put the poll up too, though. Let me see. Apologize for this. I should have been this queued up earlier. Okay, so what I'm going to do is put up a poll. And when you get it, when you get when you get the multiple choice questions, you can go ahead and fill them in the poll here, and also it'll look like this.
Professor, where's the questions?
I just emailed them.
Oh, okay. All right. Thanks.
Yeah, no, I should have done it earlier. But I wasn't thinking. Let's see. Okay. It doesn't look like you got them yet. At least I didn't get them yet. And I think what we'll do, though, is hopefully you'll get those shortly. Oh, don't do that. And then we'll, you can put them in, and I said, I think when we will come back and talk about it at, let's say, what's this one? Let's say 7. And you go ahead and start putting them in when you get the. If you want to go ahead and take a break now, and hopefully they'll be in by then. Let me check back my email. Okay, I got mine, so hopefully you get yours soon. And by the way, there are multiple choice, there are extra credit points given for this. Get at least 5, correct? Plus 2. 7, correct? Oops. Plus 3. 9, correct? Let's say 10, correct, plus 5. So whoever turns those in, whoever answers the you know what I mean. Whoever participates gets extra credit points. And we grade it as a class. Did you guys get it yet or no?
Yes, I got it.
Yeah, okay. Okay, looks like everyone answered, so we will go through these. Okay. Excuse me. Keep the CPA. Yep, did. B. Yep, yeah, got it. PO financial statements leave alone. It's okay if it's a public authority fix the fee, or these other ones. And for the most part, fees are allowed, but only there are certain things that can't be, and one of them is payable if the audit financially led to a loan. You cannot have it associated with an audit contingent fee. Okay, 2. If a CPA violates the AICPA Code of Professional Conduct, the ACCT trial board may do all the following except. Okay, kind of all over the place here a little bit, but you cannot revoke the member CPA certificate. It's given by the state, and it can only be revoked by the state. They can't revoke your CPA license. They didn't issue it. The states issue it. 3. Which of the following relations is most likely to impair CPA's independence with respect to a particular audit client which CPA works as a covered member? Okay, so a covered member. Cousin immaterial investment. Nope. Yep. Okay, very good. Which is following more closely associated with CPA, yeah, independence. Yeah, notice that that's way different than other professions. Hey, that's not me. If you're a doctor and your kid falls down and scrapes their knee, you can't say, "Oh no, we're not independent. I can't help you." So one of the weird things about a CPA firm is that you must be independent from your client, unlike any other profession, really. Okay. CPA sole practitioner purchased stock in the client corporation and placed in the trust as an educational for their minor child. The trust securities were not material to the CPA, but were material to the child. The independence of the CPA be considered impaired. This is a tough one, but you guys got it. This is it. Their minor child is a dependent. It's considered the same as the covered member. So the covered member is, even if they have one share of stock, whatever it is, it's a no-no. So it's a direct interest. One share, too much. Materiality does not matter. 6. The ACCPA allows for which of the following? I didn't talk about this one, but I will in a second. It's actually this last one. They'll allow for you to do bookkeeping services. Source documents. This is a generally a management function. So you cannot make shipping documents and all that kind of stuff for. Get it added in there. For the client, you cannot be making their source materials that you're gonna be. Auditing and so on and so forth, and. This is considered to be a management function. So you cannot do that. You can do the bookkeeping, so you can do the bookkeeping in where if they give you the source documents, for instance, invoices and all that kind of stuff. You can make the journal entries for it, and as long as they approve them, they can go in. But contingency fees based on pricing of accounting services. You can't take any contingency fee if you're doing the audit. And attestation, I don't really talk about this too much. I probably should. Auditing is an attestation. It's kind of like testifying. So auditing is an attestation. You're testifying that this is, in our opinion, this is free of material misstatement, blah, blah, blah. There are other ones too, though. I don't think we talked about it. There's a review, which is kind of like a mini audit. There's also a agreed upon procedures where I'll tell you a funny agreed upon procedure. I had a friend who worked in Texas, and I don't know how exactly this works, but I guess they have like thousands of cattle that just walk around in Texas, grazing and stuff. And then like once a year, they kind of round them up and they need someone to count them because these are actually like big businesses. And they had to sit there and count cattle, and there was an attestation that it was agreed upon procedure that they would count the cattle. And so they had to be independent and all that kind of stuff. But that's an attestation too. And so whenever you run into an attestation, it's similar to an audit. Auditing is an attestation, but there are other ones also. So attestation kind of covers everything, not just auditing. Okay. Oh, wait. Which the following X would most likely be a violation of the ACCT code? Yep. Whoever picked a B, that's not a bad one. And this is one of the weird things too, is financial forecasts. This is one of those things that I really wish would go away. But a lot of times they make these financial forecasts and they make them available sometimes to the public. And they can lead to all kinds of problems, but they're still allowed to do it. But yeah, so financial forecasts, a lot of times these are given to clients and they're given to the public and stuff, and so it can be a problem. Okay. I used to be in finance. I remember thinking, well, how can we put out these financial statements that haven't happened yet? Yeah, it's not that uncommon. After the all the Enron and all of the WorldCom and Sarbanes-Oxley came out, there were some companies that said, look, we're not giving any forecast, whatever comes out, it comes out. And I kind of thought that was a good thing, that they don't really use kind of make-believe statements or something. Okay. What's the following circumstance to occur? Remember, you consider independent when we're on spouse is the same as the client, so this one will be no. You can't be on the board of directors at all. Immaterial indirect, this is it. Yeah, you can't make investment decisions. That's a management decision. This is the one. Immaterial, indirect. Like a Standard & Poor's 500 fund, something like that. Well, you guys are on the verge. Hey, who picked E? There is no E. Was that maybe this would be a D? All right. Which the finding is least likely to impair independence? Yeah, D. Well, goody, you guys get all 5. You're all 10 of them correct. Yay. Okay. So let me stop sharing. I don't like sharing anyways. And let me download this. Okay. And let's get rid of that. Okay, so hopefully we'll finish the I'll send out the chapter 3 exam after class. Due Friday. Let's finish the monetary unit sampling. Well, hopefully we'll finish. I can't remember exactly what we got on it. So, I can't close my window because the Zoom meeting thing is in the way. Okay. So monetary unit sampling. Again, this is kind of a wacky sampling thing that it comes about it's only for overstatements. It's very good at finding overstatements. It's absolutely worthless at finding understatements. But if say you think something might be overstated, this is the one to go with. And it's specifically for auditing. It is not necessarily the best one. It depends on what you think the client's books are. And if you're not sure if the client's books are overstated or understated, you don't want to use this one. You use the classical sampling. But this is a very good one if you believe that there are overstatements or that you're worried more about overstatements than say understatements by a lot. So here we go. There are some weird rules though that kind of go along with it. So we'll cover those. Okay. Incremental allowance is an additional sampling error incurred for misstatements detected in the sample item. In other words, sampling error increases when more misstatements are detected. Okay, so the idea is that if you have misstatements, that increases the possibility of misstatements. It's only used when the book value of the misstated item is less than the interval. This is a wacky one that we'll talk about in a second here. Yeah. Wait till we get down here. I'll take a look at it. Monetary unit is only used for detecting overstatements. Understatements are ignored. So this is kind of strange. And it's really strange when you're auditing and when you come across a misstatement in auditing, first of all, auditing a lot of times has to do with tedium, kind of boring. You get a sample of 80 items and kind of, quite honestly, by the time you get to the 30th item, you kind of know where it's going, good or bad. But as you go through and you find an error, a lot of times you go, oh, I got to separate this out and hit a little write-up thing on it or whatever, what the error was. If it is an understatement using the monetary unit sampling, you ignore it. And it kind of goes against your whole, your whole feeling of auditing that, hey, I found something. If it is an understatement, you ignore it. It's kind of like fishing and you reel in a boot. You don't want to throw it. Well, maybe you don't throw it back, but you get the idea that you're only looking for fish. So if in case something else, you don't. So in this case, you're only looking for overstatements. You find an understatement, you just ignore it, which is kind of strange. If the misstatement has a book value equal to or larger than the interval, then the misstatement is the difference between the book value and the actual value. In other words, it's the actual and we'll talk about that in a second. Okay, so here's some wacky rules. They're just part of the fun. Okay, so we have a book value of 800,000. You have an interval of 4. Oh, here's a question: how many items are in our sample? The interval is 40,000. The book value is
$20.
That's a question I don't know the answer to. Hey, I think you're right. I think it is. So it'll be 80,000 divided by 40,000. 800,000 divided by 40,000. Yeah, I think it's 20. So there'll be 20. There's 20 items in the sample. Okay, so interval is every 40,000. So here we have the first few ones here are pretty run of the mill. We're just going to go through these normally. These last three are going to be wacky. So the first three are kind of normal. Okay, so we have 14,000 divided by 20,000. Times the $40,000 interval. What's a projected value of some number? $28. And we're going to do the math. So points.
Yes, 28.
28. Okay, so just 28,000. So the projected value would be 28,000. And what would the projected misstatement be? So the interval is 40, so the projected misstatement is 28. So scratch that. The interval is 40,000. The projected value of that is 28. So how much has it misstated by? 12? I think it's 12.
Yeah.
Oops, that's not how you make 12,000. Oops, no, that's messed up. Okay. So the first one here, projected value is 28. Go to the second one.
32,000.
32, thank you.
$8,000.
2,000. This next one I put on here for a reason. Now, in the book, they'll say, if you come across this where the actual value is 0, you have to investigate why. The reason I think it's kind of weird is that you got to do that anyways. You're always looking at why is it, why is it 0, or why is it understated at all, or overstated, I should say in this case. But yeah, so they say you have to do a little more investigation. But the truth of the matter is, if it is valid, if it's 0 and they have it for 1,700, it means that the whole thing is off. And so here the misstatement would be the entire 40,000 interval. I just always think it's funny about when someone says, well, then you have to investigate it, because you better investigate it anyways. I mean, you're going to investigate why this is off. You're going to investigate why this is off, and so on. That's how you come up with the number. Yes. Okay. This is an odd one. Number 4 is odd. What is odd about number 4?
It comes in point.
Yeah, it comes over 1, right? It comes in, if you were to divide these, 2,600 divided by this, it's higher. This is an understatement. It's not supposed to catch these. Oops. When it does catch them, it ignores them. This. The book, the audit is higher than the book. This is understated. And you simply ignore it. This is no error at all. So this is. Okay, that looks funny. Hold on. Try that again. So this is not an error at all. There is no error. And again, that kind of rubs you the wrong way a little bit, because you're an auditor and you find something that is misstated like this. You say, hey, there's a problem here, but if you're doing the monetary unit sampling, it's not a problem. It's fine. If that bugs you, it should. It bugs me. But anyway. Okay, down here is kind of this weird special problem. And that is this. It happens right here. The book value in this one is higher than the interval.
For number 4, you meant 40,000 or?
Oh, yes, I got a little crazy there. I'm sorry, yes, yeah, 40,000. So in other words, there is no misstatement. You know, period. That's that overachiever in me, that putting those extra zeros in that are wrong. Okay, so you'll notice that this is a kind of a strange one, and that is that the book value is higher than the interval. So this book value is higher than the interval, and I'll say a couple things about this. First of all, if this item was, if management was purposefully overstating this, they really got it wrong, because this is 100% sure it was going to get caught. The book value is higher than the interval is going to get caught. And that's one of the beauties of this method, is that when the book value is higher than the interval, it's 100% sure that it'll be got. And the more that management overstates something, the more likely it is to get caught. So that's one of the beauties of it. Now, here's the problem, though. And that is, if you look at what this is actually misstated by, they actually say the actual misstatement is, oh, geez, I'm gonna do that. Hold on. So the actual misstatement is this is the actual misstatement for that item, right? It's 33,000. This is what it's actually off by. I'm going to go ahead and do this as if we didn't know this, and I will show you why we have to make a special arrangement here. Sorry, don't do what I'm doing. I'm doing it wrong. This time I'm doing it wrong on purpose, but nevertheless, I'm still doing it wrong. If you were to multiply this out, 11,000 divided by 44,000 is, I think it's 25%, right? So this would be projected value would be 10,000. And the projected misstatement would be 30,000. Now notice this. What we know that this thing is actually misstated. Just this one account is actually misstated by 33,000. If we were to do this multiplication, we would, it would only show that it's off by 30,000, which is understating what it's misstated by. It's actually misstated by 33,000. So here is the wacky rule that if, get rid of all this. If the item picked is larger than the interval, so if the book value is larger than the interval, you go with the actual misstatement. So in this case, this would be 33. And those would be the actual amount. Okay, excuse me. So, we would ignore this. Well, I mean, you could put something in there if you want, 7,000 or something. But this is what you will put in for the misstatement. So if the book value is higher than the interval, then you simply take the actual misstatement. And in this case, that is 33,000, and that is what you put in for your projected misstatement. So in this case, a projected misstatement would be the actual misstatement for the item. And notice down here is the same thing. You know, this 90,000, this one would not only be caught in one interval, it might be two. It may even stretch into 3 intervals, depending on what is picked, but it's the same idea as this up here. So we're going to do the actual misstatement for this one. Okay, hopefully they stop barking. All right, so they're coming down here. This is going to be 90,000 minus. So again, we're in the same boat as up here. Ooh, I want that. So we have 90,000 minus the 65,000.
25,000.
Okay, thank you. So this is the actual amount that it's misstated by. And so we will use. These two tiny little dogs. Don't harm anything and they go berserk. Okay. So again, if this is the strange situation, well, I guess not so strange, but it's a situation where the book value is higher than the interval. 100% sure it's going to get caught. We use the actual misstatement instead of a projected one. So calculate projected misstatement for this, it would be all these together, whatever they come out to. 15.
$118.
118.
Mhm.
So this will be our projected misstatement. There's something else here. Okay. We're to have an A and not a. Calculate the estimated accounts receivable balance. Okay, so well, it comes up here, right? Let me get rid of this for a second. So 800,000 minus projected misstatement of. And by the way, this is always going to be a projected overstatement for this one. Because that's the only thing it looks at. So projected overstatement is on 118, so we'll subtract 118.
$682.
So, yeah.
Okay, so this will be our, what we estimate that their projected value would be. The projected balance in the accounts receivable. Okay. Incremental allowance. Incremental allowance we have not talked about yet. It has to do with the fact that if you do find an error, that indicates there might be more of them. So the more errors you find, the more likely you're going to have more error in the sample. Yeah, if you don't find any errors, you're less likely to have more errors in the sample. Where if you find errors, you're more likely. Okay, so that dog you hear barking is all of 13 pounds. Large cat would have no trouble with it. Okay, so including incremental allowance. So if there is a misstatement in general, it means that there could be more. So for this first one, yes, it would be including the incremental allowance, and we don't know what that is yet. I'll show it to you later. Number two, yes. Oops, that's wrong order. Number three is yes. So these first three are, it's all possible, you know, that there's an error, so there could be some more error because we found errors. The existence of errors means there could be more. Number four really isn't it's not an error at all, according to our rules. But obviously, it's not an error. It would not be in the incremental allowance. This one would not be considered an error at all. Now, here is the wacky ones down here. Because these cover the entire interval, this one actually covers two intervals. Because they cover the entire interval or more, there cannot be anything else wrong in those intervals. They cover the entire interval. So these are actually not included in the incremental allowance, which we'll talk about shortly. So these first three would be included in incremental allowance. There could be more problems because there's still room in their intervals for problems to occur. This one isn't, this one really isn't anything at all. Yeah, it's not an error at all. These two, they are errors, but there couldn't be anything else wrong in that interval because this covers the entire interval. There's nothing else in that interval that could be misstated. So those are not going to be included in the incremental, which I know is something we haven't talked about yet, but we will. Okay, so they're kind of wacky a little bit, you know, kind of the rules. So let's go down to this one. And see if you can do these first. I'll be quiet and see if you can do these first three. So find the projected misstatement. No, I'm going to build all this. So go through each one of these down here and see if you can figure out what the value should be. And I am going to 40,000,
Yeah,
10,
10,000.
and we'll talk about the incremental allowance in a second.
20 and 30.
20 and 30, okay. This one,
It's negative, so
ignore it. Yep.
ignore. Yeah.
So this one, the the audit value. Oops, no, let's do this differently. Is greater than the book value. This is a overstatement. Correct that. It's an understatement. So this is actually an understatement. We ignore it. This is and truthfully, there is no misstatement here. This is everything's fine. Which again, like as an auditor, you run into this, you immediately think you should tell somebody, but according to the rules here, this is an understatement, and we're not looking for those with this method. So it's 0. Okay, incremental allowance. Now, as long as the book value is less than the interval, which they are in these two cases, it'll be in the incremental allowance. Oops, what I did there. Hold on a second. In other words, this book value, this $10,000 is less than the interval. There still could be stuff wrong in this interval, because this one only covers, the book value only covers $10,000. So there could be additional amounts in there, and same for this one. There could be additional amounts in there. So these are both yes. Oops. I do that every time. Now this one, it's not an error at all. So this is no. But to be honest, even if you tried putting it in, it wouldn't matter. So anyway, this is the calculated projected misstatement is
40,000.
Yep. Very good. Thank you. Oops. More. Okay, so the projected misstatement is 40,000. And this is our best estimate as far as what the books are misstated by. It's 40,000. However, it could be off by more. Because this is a sample, it could be off by more. Hey, that's not me. You can tell by the years. Okay, it's a sample. So we got our best estimate, but it could be off by more. And there's two things that can make it off by more. One is just a sample like any other sample could be off by some, but also we have some errors, and errors mean that it could be off by even more than that. So initially, the what we think it's off by is 40,000. That's our best estimate. However, it might be off by more than that. And that's what these next two parts to it are. Okay, basic precision. This is just a calculation that we do based on a formula. Can I put it down here? The basic precision formula on here. Okay. Here's the basic precision formula. No, it's not. Where is it? Here it is. Sorry. I don't know why I didn't, but I thought for sure I had that right in there. I right in the problem itself. Obviously, I did not. Okay, so here's the formula for the basic precision. It's not that big of a formula. Something weird has happened. I'll just do it down here. So basic precision equals the interval, which in this case is the 50,000. Times reliability factor. It'd be quicker to go up near the top here. Yeah, it is quicker. So reliability factor. Oh wait, I gotta see what's the percentage, right? Oh, risk of incorrect acceptance is 5. Okay, so we're gonna be at the 5% level. Let's go back to. Okay, so at 5%, the reliability factor is. I wish I had set this up a little bit. So basic precision. Row 0. %. So it's 3. This is at the end of the document. It's not gonna help you guys. Go ahead.
Didn't we have Miss
We did it for sample size. Yeah, it'll be the same. It'll be the same reliability factor you use to find the sample size. Yep. So row 0 is used for sample size and basic precision. So this is basic precision. But yeah, you'd also use it for the sample size that we did problems 2 and 3, I think. Yeah, so this will be, now you're gonna multiply this by the interval. So this is, and again, yeah, it is exactly the same reliability factor that you would use for. So this will be your basic precision. So what is that? 150,000. I have no idea what my cursor is doing anymore. Oops, that's not right. Okay, so basic precision is 150,000. And so here's what this tells us. What's going on here? What are you doing? Hey, I got it back to normal, kind of. Okay, so here's what it tells us. The 40,000, that's our best estimate of what this is off by. Basic precision is 150,000, and you might be wondering, well, what is that? What's 150,000? The 150,000 says that, okay, this is a sample, and even if nothing is wrong, it could be off by a certain amount. So this is. If no errors are found. So this is the error-free rate. So even if you didn't have any errors, there's a possibility this could be up by $150,000 more. So you did your sample, you estimated this up by 40,000. Even if you didn't find any errors anywhere in it, it could be up by another 150,000. Why? Just because it's a sample. We didn't take every account. You know, we only took a certain number of them. So there is a possibility this could be up by 150,000, even without any errors in the sample. Okay, now if we do have errors, we come down here to the incremental allowance, which I promised to tell you about, and now I will. It is wacky. Okay, the first thing you have to do is find what the incremental is. And this is the formula. Overstatement 1 minus overstatement 0 minus 1. So I'm going to come down here. I promise to make these more. Well, maybe I can just copy those. Okay, wait, wrong ones. First of all, let's go to the correct ones. I'm going to copy these and bring them up here just for ease of use. That may have been a mistake. Okay, so here is overstatement 0. In other words, no overstatements. This is overstatement 1. This is if there's 2 overstatements. And this is if there are 3 overstatements. Now, they could make a table for this, which would be very easy, and I wish that they did. If I ever do make a book, it will have that in it. But so let's take the first one. So overstatement 1 is 4.75. So we'll take this. Minus overstatement at 0 is that 3. We minus 1. And something funny here, equals some number 0.75. So this is the increment. And I'll tell you what we do with it in a second. Let's go ahead and make the increment for overstatement number 2. Okay, overstatement for number 2 is, let's reset these. $6.30. Minus 4.75. Minus 1. Equals some number. 0.55. We really don't have to do this third one, but I'll just kind of wrap it up. I'll put it on there, and that is. Now, in case you're wondering, could you just make a table for these incremental? Yeah. There's no reason why you couldn't just put that in a table that here's the incremental for at 5%. This is the incremental for 1, 2, so on. But they have us jump through hoops. Oops. Your eyes are glazing over right now. I don't blame you. Okay. Or 6. Okay, so we take the reliability factor increments. That's what we just did here. And we're going to multiply them by the misstatements, the largest one first. Do I have misstatements? I'm on the wrong one. Hold on. Let me move this all up. And it's sad, this one has a different, it's at 10%, so I can't use it even there. Okay. So let's take a look at our misstatements. So here's the 2 misstatements. So which one is the largest? You guys are just too tired. Here's the largest. Oops. Okay, so 30,000 is the largest. This is the one we're going to multiply first. Uh, 22,500, I think. So that's our largest misstatement. The second misstatement is 10,000.
It will be 5,500.
Oh, right, yeah. Very good. Oops. And there actually is no overstatement 3. We can ignore this one. If there was one, and we may say, why did I put it there? In case somebody, thought that this one needed to be put in there, I would have it in there, but let's take this out. Okay, so the incremental allowance will be And, you know, why we have this incremental allowance is that.
28,000.
Oh, right,
28,000.
yeah, you're right, 28,000. The reason why we have it is that, they say, look, you know, you found some errors, which means that there could be more errors. And the more errors you have, you know, the more uncertain it becomes, so this incremental allowance of 28,000. Says, okay, because you had these errors. Now, if you didn't have any errors, it would just be this. But because there are some errors in your, you know, misstatements in there, that more could be misstated. The likelihood of misstatement goes up because you have some misstatements. Okay, so all these three together will give us the, what they call the upper limit. And we are not going to finish this thing tonight, obviously. Okay, so the upper limit is 150. 218, maybe. You want to check that.
Yeah, it's 218.
18 is right. Okay, good. So this is our upper limit on it. So our best estimate is the 40,000. This is what we believe that, you know, this is our best estimate of what it's off by. However, this is a sample. And if we had no errors, we would still have to get a allowance of 150. Because we do have errors, there's the more likelihood that it's going to be off by more. So that's where the 28,000 comes in, saying, look, because you have these errors, there's likelihood it could be $28,000 more. So this is the upper limit, is 218,000 on this statement. So this is what you would use and compare that to the book value of 600,000. I'm gonna copy and put it in for a second.
It will be 382.
I'm sorry, what did you say it was?
It will be 382.
For what?
Aren't we gonna minus
218.
yeah.
Okay, right. Wait a minute, what I did? Yeah. Oops. Yeah, actually, I would have right. So 6 million minus 218, whatever that is. 6 million or 600. Whatever that. So. $5,782,000. So this would be what we would be using to see if it is, you know, is it okay? If the books are off by 218, which it very well could be at 5%, are we okay with that? And this is a judgment call, you know, whether 218 is too much for us to handle, you know, or for us to accept. But this is the amount that we would project, that this is with the upper limit on the misstatement right here. This would be the amount that we would compare to, you know, the 6 million. So, okay, can we accept this or not? Again, that's a judgment call, but this is how you use it. Okay, let's stop here. I don't even have enough room to stop. And we will continue this next time. And I know I went over, and I apologize for that. It's I don't usually go over. But let's go ahead and save that. And so what I'm gonna be sending out tonight is the chapter 3 exam. And you should get that probably within 10-15 minutes. And it'll be due, well, I want to just go back to this. So tonight, the chapter 3 exam, and it'll be due on Friday, the 14th. And I will make a drop for the chapter 3 handout, which we just completed. So I'll put that in Blackboard. And then I'll also put one in for the exam. And do not turn in this thing, the monetary unit one. We'll go through this next one, next class. These take a long time. Okay. Questions on any of that? So chapter 3 handout, you guys just did, finished up. I'll put that in the assignments in Blackboard. I also put the chapter 3 exam in the assignments in Blackboard, and then I'll send out the chapter 3 assignment. You should get it within a few minutes. Let's say 20 minutes, just to add it a little bit. But so I'll send that out after class. Any questions? Okay, sorry for keeping you along, and I will talk to you guys in a week's time.
All right, take care and thank you.
Thanks. Have a good evening.
You too.